Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on this, the 27th day of July 2017. I'd like to remind you each week that I am the author of a newsletter, Jay Taylor's Gold, Energy, and Tech Stocks. You can subscribe by going to miningstocks.com. I'd also like to encourage you to consider subscribing to Chen Lin's newsletter, What is Chen Buying, What is Chen Selling? You can go to chenpicks.com, chenpicks.com. He has had a remarkable track record, and you might want to consider subscribing to Chen. And frankly, things are going pretty well for yours truly now, too, with the gold exploration stocks. I am extremely excited about a number of the sponsors that we have on our show, and we'll be talking to more and more of them over the next few weeks. Well, we do want to welcome one new sponsor this week, Firewood Zinc. We'll be talking to the CEO of that company. That's Brandon McDonald in about a quarter past the hour. They're advancing a zinc lead silver project forward that's up in the Yukon, but it's a very advanced project with lots of resources already, and I think a stock that's selling at just a minuscule market cap, I think, has a great deal of upside potential, so you may want to be sure to hear what Brandon has to say. I do want to thank the other sponsors that we have for today's show. They are New Range Gold Corp, Telson Resources, Klondike Gold, RN Resources, Novo Resources, Genesis Metals Corp, and GMV Minerals Corp. I've titled today's show, America's Decline, the Dollar, and Gold. William Engdahl will be with us. Michael Oliver will be speaking with you in just a couple of minutes, and Brandon McDonald, as I said, will be with us about a quarter past the hour. The deep state and its propaganda programs deprive Americans of knowing the actual reasons we are asked to give our lives and treasury in funding unending foreign wars. Enabling the U.S. empire to expand and dominate after World War II was the forced acceptance of a post-1971 dollar, what I call the fraudulent dollar, orchestrated by the deep state that pulled the strings on our President Richard Nixon. By detaching gold from the dollar, America could print endless amounts of intrinsically worthless money out of thin air and use it to fund a military that punished any leader who refused to accept dollar payments for its oil and other goods that it cared to sell internationally. But now some of the larger remaining powers in the world, like Russia and China, its allies, who have sought, in many ways, at least for now, a peaceful economic coexistence with Washington, are saying that they will not submit to Washington's bullying tactics any longer. They are seeking a peaceful coexistence with the West, at least they have sought, perhaps because of weakness, they have no other choice, and seeking actually to expand their economies in that way. But now, our neocons have apparently taken control, I believe, of the Trump administration. There's growing signs that that's the case. I'm not surprised, but that seems to be at least my read of it. Just as they have other presidents, and the recent warnings that Syria will soon be launching another sarin gas attack. How do we know that? Well, maybe it's not Syria that's launching the sarin gas attack. We'll see, but there are certainly a lot of skeptics about previous false flags. Many people think they have been in the past, and just an excuse to go to war. I mean, our military-industrial complex needs to have wars. That's how they fund themselves. That's how they get wealthy. It's a growing monstrosity that Eisenhower warned us about many decades ago, and now I'm quite convinced that it is pretty much a very powerful force in the geopolitical realm. Well, there are very few people in America who, I believe, who understand the other side of this rising conflict between the East and the West. New York University professor Cohen is certainly one who understands Russia and sees it in a little different way than our mainstream media projects it. But my main guest today, F. William Engdahl, who was born in Texas, American, but now resides in Germany, is knowledgeable and balanced in his worldview as anyone I know, and he is extremely knowledgeable about how the East is using economic means to try to stand up against a growing United States force, an Anglo-American empire, if you will. While it may seem as though the U.S. can use its military might to force rulers like Saddam Hussein or Omar Gaddafi out of power if they choose to accept currencies other than the dollars, the problem is that the United States has problems of its own a cancer, if you will, that is growing because of an illegitimate monetary system. And so there is a tide against the dollar. The foreign powers are resisting it, are using their own currencies and gold, in fact, for trade amongst themselves. And the dollar is one that many of us have thought would come under extreme weakness in time, and certainly that's been the views of Michael Oliver, and he is with us right now. Michael, thanks for joining me again today.
Good to be back, Jay.
Speaking of the dollar, just as we were ready to come on the show, I noticed that it was down 1 full point. It was right before the show about 96.96 or 96.15. This is on Mario Draghi apparently made some hawkish remarks and drove the euro higher. And I know that you've been believing that the euro is entering a bull market, the dollar a bear market. So what do you make of today's move in the dollar? Or is the dollar going to get really weak, do you think, in the near term?
I think so. But every trend has layers, and I suspect there are layers here. I got a lot of my subscribers who read, obviously, other market letters and so forth, sent me a lot of emails the last few weeks saying a bunch of the analysts out there expecting a strong dollar rally. And so last weekend's report, we ran a study on the dollar, and it was 2 weekends ago, and I said, no, they've already had 4 weeks of on our oscillators of rally. They got 2 more at best. We're now in that second week. And I said, I don't think they're going to probably get up over 98 or so. I don't even think they reach 98. And now in the 96s, it just looked like it's not the appropriate place if I were a dollar rally guy looking for even a counter trend rally, counter to the new bear market, which I think it is. This 96, 97 level is not it. You might try 95 to get a little foothold. But the real support for the dollar right now is down there. It's around 88.
Wow.
Well, that's another 8 points lower on a 96-point index. Well, you do the percentages, and for the dollar, that's a big move. And so I think that's where the next major support is, and I don't think it'll ultimately hold, but I think it's a place where there could be some fight. It's around 88. Well, it's a long way down. And on the euro, which is a 113 area, I think if you ever touch 116, they're going to get very excited, the price chartists. And I think you could run it up into the 120s without much trouble. So that would be commensurate with the dollar dropping to 90 to 88. Now, at that point, finally these two currencies have come off dead center. They've been dull as pond water for 2 years, really. And finally, they've come off dead center. And I think it'll have repercussions. I think it will help commodities. I think it'll hurt certain other assets, like government debt, U.S. government debt, T-bonds. And especially one thing I'm looking for the commodities to help them, it's asset class shifts. We all know that the central banks print money and it creates rivers of liquidity. Okay, well, that's one thing. But it doesn't always go where they want it to go. Bernanke wanted it to go into stocks from 2011 to 14, and he got his wish. He went into the stocks and priced them off the page, places they would not otherwise have been, quote, unquote. So we know that's a goal, but ultimately that never persists. It gets to a point where the market says, you're just not going to get your wish anymore. We're going to put it somewhere else. And that's a decision made by, millions of investors, smart investors, stupid investors, big investors, small investors, who shift their preferences. And I strongly suspect that if we get a good sharp wobble in the S&P, the kind that most people would call a, quote, correction, call it 5 or 10%, I think you're going to get a lot of money from smart people who say, okay, I've had enough of this. This thing is really vastly overpriced. We've priced in some kind of nirvana based on Trump on top of 4 years of central bank pricing of stocks upward. I mean, this thing's priced on top of itself 4 times. And I think smart money is going to say, where do I go? And if you look at commodities just on a simple price basis historically, like sugar or cocoa or orange juice, whatever, they're all at very low levels relative to the last decade, particularly if you price in some monetary inflation. So I think they're going to see value there, and I think some of the money is just going to say, I'm out of stocks, I'm going to move 20% of my portfolio that's going into commodities here, there, and everywhere. And I think that will show up as well. So I think it's both the dollar drop will help commodities, and 2, a first sharp wobble in the stocks I think will benefit commodities, simply because the asset preference is changing. And,
right.
Yeah.
Well, it certainly wouldn't take a lot of money coming out of the gigantic equity and debt markets, especially, to to drive commodity prices very much higher than they are now, I would think.
I agree, absolutely. It's a small arena compared to those other ones, yes.
Right. Well, with a minute or two left here, speaking of debt, the T-bonds looking very weak as well. You've pronounced a bear market for T-bonds, a bear market for the dollar, bull market for gold and commodities in general. As you say, the equity market seems to be teetering, sort of an arm wrestling engagement there. But the T-bond in a new bear market, you said, a substantial one, I believe. You still, how's that looking to you now, and where might we be looking for the T-bond?
We got bearish on T-bond futures at 166 last October. They dropped to 147 by March. They've had a rally back up to 157. We think maybe they'll see 158 despite today's wobble before they peter out this rally, which is rather extended time-wise. And it's the next leg down that we're trying to time. They've had a lot of dips in this rally that haven't taken hold, and we didn't expect them to, but there will be one soon, I think, in the next several weeks probably, that does take hold, and the T-bonds will then roll over for a whole new leg to the downside. And we suspect they could go into the high 120s on the T-bond futures. Well, in a yield, convert that to yields, that's 4.25% yield. So it's a substantial rise in long rates. It's more than a doubling from the lows they saw last July 2016. So we're looking for that next rollover in T-bonds, the next leg down in the bear market. And we suspect it'll start sometime in the next month, a few weeks.
All right. For people who think that higher rates mean the death knell for commodities, for gold and things like that, what do you say to them?
No, I mean, go back to your history. Higher rates can also mean, inflation, or the popular conception of inflation, which is rising commodity prices.
Right.
We always have inflation. I mean, when you double the money supply every decade, effectively,
right.
You've got pricing of this asset or that asset higher than it otherwise would be. It doesn't have to be rising to be inflated. Because, after all, a certain asset might be lower than it is presently, except for the inflation. So most people misinterpret that. But the popular conception of inflation could well come back, and I think that would be a rapid ascension of low-priced commodities. And when a market is way below water level and finally comes out, it's like a beach ball underwater, the first move can often be very dramatic percent-wise, just to get back to sort of equilibrium.
Right.
A whoosh effect. And I think we're
the whoosh effect.
Yeah.
Thank you, Michael, for being with us. We do have to go to break now, and I'll look to talk to you next week.